Here again with Smart System. In our last lesson, we learned about the stochastic oscillator, an indicator which helps us gauge momentum in the market. In today's lesson, we're going to learn about Bollinger Bands, an indicator which helps us gauge the volatility in the market, as well as how high or low prices are relative to their historical price action. So let's get started. So Bollinger Bands are comprised of three bands, which are referred to as the upper band, the lower band and the center band. The center band is a simple moving average, which is normally set at 20 periods, and the upper and lower band represent chart points that are two standard deviations away from the moving average. Bollinger Bands are designed to give traders a feel for what the volatility is in the market and how high or low prices are relative to the recent past. Basic premise of Bollinger Bands is that prices should normally fall within two standard deviations, represented by the upper and lower band of the mean, which is the center of moving average line. As this is the case, trend reversals often occur near the upper or lower bands, as the center line is a moving average, which represents the trend in the market. This line will also frequently act as support and resistance. The first way that traders use the indicators to identify potential overbought and oversold places in the market by watching for touches of the upper and lower bands or trading outside of those bands, which tend to represent extremes. Although some traders in the market use close outside the upper-lower band as buying-sell signals, John Bollinger, who developed the indicator, recommends this method should only be traded with the confirmation of other indicators, outside of the fact that, as we've talked about in previous lessons, most traders would recommend confirming signals with more than one method. With Bollinger Bands specifically, prices that tend to hug or even trade outside of the upper-lower band for long periods of time, specifically in strong uptrends or downtrends. And that's obviously not a situation where you want to be positioning for a reversal. So because of selling the upper band and at the lower band is a technique that, if you are gonna use in, actually a pretty good technique if you use with other indicators in range-bound markets. So that's what we're gonna look at here. Can see here is the chart of the Qs, which is the Nasdaq ETF. And you can see here we have a ranging market there. We have a trending market here. And you can see that in the ranging market, we had multiple touches of both the upper and lower band, but in the trending market, it was hugging the upper band for a good portion of that time. Now the trade set up here, we could look at, just buying or selling on a touch of the upper and lower band. But a better method would be to combine with another indicator, which I've done with RSI here, learned about 2 lessons ago. And you can see that you've got a divergence here as price moves up to a new high, but RSI does not confirm. So there will be your sell point. And then the buy point would be when the market pulls back off of the lower band, because in range-bound markets, we're anticipating that a move that starts at one end of the extreme high band is going to move all the way through to the low extreme, which is going to be the low band. And so we don't want to get out of the trade before it's finished following through. If it goes into a downtrend, it continues to hog that bottom line. We want to be in that trade, so we're gonna wait for a pullback off of the bottom Bollinger Band line. The second method is what's known as the Bollinger Band contraction, and in general, after their periods of low volatility in the market tends to rally rather significantly. As we've learned in some of our other lessons, periods where the market doesn't move that much, up or down, or indication that neither the bulls nor the bears are winning. So when one side does win, the market tends to move pretty dramatically in the direction of the winning side, whether that be up or down. So low volatility is obviously represented by contracting Bollinger Bands, and high volatility would be represented by widening Bollinger Bands. So you can see here, we have a contraction in the Bollinger Band there. And then we have a break above the top Bollinger Band, meaning that the buyers have won out in this situation, and we have a nice run up after that. Now, be careful when you're trading this strategy. The first break above or below the Bollinger Band line tends to be a fake out, so it actually reverses and goes in the opposite direction, and a lot of traders will trade the second break to avoid getting faked out and pulled into a trade in the wrong direction, because they're an indicator which is plotted on price, or just a good indicator to use with other things, such as some of the things that we've learned so far here. So by looking at this chart, and if you've been through some of our other lessons, you should be able to identify the double top there. You should also be able to identify the divergence in that top. which is represented by the relative strength index, meaning that not only do we have a double top, but going up into that second double top, there was a loss of momentum compared to the first top. So you can also see the touch of the Bollinger Band there. That represented a pretty good move down in the market. Now there's lots of resources out there, because Bollinger Bands is one of the most popular indicators. We're talking about strategies and everything. Remember that trading is risky. Nobody, certainly not me, can guarantee profits. You should design your own strategies. This is just meant for information purposes, Mombia. Make sure you do your homework before getting into the market. Make sure that you're only trading with risk capital and that trading fits into your investment profile. So that's our lesson for today. In our next lesson, we're going to learn about something called the ADX, or the Average Directional Index, which is going to help give us an indication of strength or weakness of trends in the market. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. Have a great day.